if that's all you knew about the 7-year rule, it's quite likely, I would say, that you would misunderstand how this whole thing works, because there's some specifics around how the rule is applied that kind of changes the equation quite a bit, right?
Absolutely. So there is some small print that most people don't see, and it means that they very much misunderstand how the rule is applied and think it will reduce their inheritance tax bill when in fact it probably won't.
Hello everyone and welcome back to the Personal Investor Podcast. I'm Ed Monk and I'm joined by my Fidelity colleague Marianna Hunt to talk about one of the most contentious areas of the tax system, that is inheritance tax. And in particular, we're going to be talking about one of the main methods for avoiding IHT, that is the 7-year rule. A lot of us have heard of it, but very few of us really understand how it works in practice. And that misunderstanding could mean that you're headed for a much higher tax bill when you die than you might think. Before we get into it, I will just say that if you find this video useful or interesting, to please subscribe to the channel, give us a like, join the discussion in the comments if you want to. It really does help other people find what we're doing here, and it means that you're going to get updated content as soon as it is released. That said, Marianna, welcome along. How are you?
I'm well, thanks. How are you, Ed?
I'm very well. Before we get into the details of the 7-year rule, which is the technical thing we're going to talk about today, let's give an overview of IHT generally. What are the headline details of how the tax works?
Sure. So IHT, or inheritance tax, is a tax that's collected when someone dies based on the value of their estate. So it only applies in the UK once the estate is worth more than £325,000, and that goes up to £500,000 if that person has passed on their main home to their direct descendants, so their children or their grandchildren. And it's even better news if you're a married couple, because you can pool your allowance and combined you can pass on up to £1 million IHT free. Now, anything over and above those relevant thresholds will be subject to inheritance tax, and the headline rate at the moment is 40%, which is quite punchy.
Yeah, and underneath even those details, there's a whole load of allowances that you can, special rules, spousal allowances, all sorts of things that will apply. But that's a pretty good place to start. The 7-year rule, I guess people might have heard of that. What is that at a high level? And why do we have a rule like that?
Yes. So there are lots of, as you said, there are lots of loopholes and allowances when it comes to inheritance tax. And one of the most popular is gifting. So giving some of your wealth away before you die to reduce the value of your estate for inheritance tax purposes. Now, if you make a gift and you live 7 years or more after making that gift, then it's a relatively straightforward process. That gift should be free from an inheritance tax. Now, if you don't live another 7 years, that's where it gets complicated. The gift might still be free of IHT, but it will depend on whether it fits into any of the quite specific allowances HMRC has around gifting. So, for example, you can give away up to £3,000 each tax year, IHT free, which is known as your annual exemption. You can also give away some money for a wedding, and the amount will depend on whether that's your child's wedding, your grandchild's wedding, or someone else's wedding. You can give away up to £250 to as many people as you like, but only if you haven't used another exemption on them. So as you can see, that there's lots of rules, but if your gift doesn't fit into one of these quite specific rules, then it counts as a failed gift, and it's quite likely that IHT will apply in that instance. Yeah,
and a 7-year rule, or these rules around gifting, is because the government doesn't want to make it completely out of bounds to give money away. There's all sorts of reasons, perfectly understandable reasons why, you might want to give money to kids or whoever you want, really. You can do it, but what the rule is there to sort of lay out is, the circumstances where people just give their money away right before the moment that they die in order to reduce a tax liability. And the 7-year point is the key date. Now, you said that if you give a gift and survive 7 years, it falls out of your estate, but complicated things happen if you die before that point. And specifically, the rate of IHT reduces. You mentioned a 40% rate for IHT. That reduces, doesn't it, once you hit certain points after the gift is made?
Exactly. So there's something called the taper, and this essentially means that the rate of IHT that is applicable will reduce depending on how long it's been since you made that gift. So if it's 3 to 4 years after you've made the gift that you died, then the rate will reduce from 40% to 32%. If it's 4 to 5 years, it will go down to 24%, and so on and so on. And then if it's 6 to 7 years after making the gift that you die, it's all the way down to 8%, and obviously 0% if you live more than 7 years.
Yes, well remembered. Well remembered, all those numbers. But if that's all you knew about the 7-year rule, it's quite likely, I would say, that you would misunderstand how this whole thing works, because there's some specifics around how the rule is applied that kind of changes the equation quite a bit, right?
Absolutely. So there is some small print that most people don't see, and it means that they very much misunderstand how the rule is applied and think it will reduce their inheritance tax bill when in fact it probably won't. So the small print is essentially that the taper relief only applies to gifts made over the inheritance tax nil rate band, which is the £325,000 that you can pass on IHT free. So how it works in practice is if you've got a failed gift, so you've died and it's not been 7 years, then that gets added back into your estate for inheritance tax purposes. And it's the first thing to use up your nil rate band. So there's no IHT immediately to pay on that gift. However, it means that you've then got less nil rate band to use on your other assets, and potentially your other assets are now going to be over the threshold, and you're going to be paying the full whack 40% IHT on those assets. So if you had a £100,000 failed gift, then suddenly you've got only £225,000 left of the nil rate band to use on your other assets.
Yes, and the tapered lower rates that we spoke about only applies on the gift above the 325.
Exactly.
And so that's the bit that can catch people out. I do think this is a big misconception. I'm going to confess to having this misconception. I don't always write about IHT, but I did know about the 7% rule. The 7-year rule and the tapering that happened. And I think, like a lot of people, I assumed that you give a gift, and that were you to die, short of those 7 years, that whatever rate is applicable would apply to all of that gift. And then the rest of your estate would be subject to the rules in the normal way. You'd have a nil rate band, and the excess above that would be subject to inheritance tax.
That would be logical.
That would be logical, but it is that extra bit of detail that really changes everything. Now, we try to lay this out in an example to explain a bit more simply what's going on. So hopefully we can show this on screen now. It should be there if you're watching on YouTube. If you're not, apologies. If you're only just listening to this, I am hopeful that it will just make sense anyway. What we've looked at here is an individual with £1 million of wealth. We've simplified all the details of this example to make it as simple as possible, and the numbers are just big round numbers. Obviously, £1 million of an estate is a lot. £1 million of wealth, not passing on a primary residence. We don't have to consider that extra nil rate band that you mentioned before, and no spouse, which is another thing to simplify things. And this person wants to gift away £500,000 in order to reduce their liability. They do that, but then they die, and they die a little more than 5 years after making the gift. And according to the rules, the IHT rate, if you've survived just 5 years, falls under the taper to 16%. So from 40% to 16%.
It's a big difference.
Big difference. Now, the IHT they pay is worked out according to the following. The gift is a failed gift, so it falls back into their estate. We're going to assume that they've still got the other half of their £1 million. Add that gift of £500,000 back in, their estate stays at £1 million. The 325 rate nil rate band applies. That leaves 675,000 exposed to IHT. However, some of that is going to be subject to a lower rate. In fact, 175 is subject to that 16% rate, generating a 28 grand tax bill at that point. The other £500,000 is taxed at 40%. That means another £200,000, and it creates a total IHT bill of £228,000. A lot of numbers. I'm going to apologise for that straight away, but hopefully if you're watching on screen, you can follow that. That might be a little bit more than people assume.
Absolutely. So if you had assumed that 16% tax rate would have applied to the entire £500,000 gift, then that would have resulted in an £80,000 tax bill. And then you might have thought that, you could still use your nil rate band on the rest of it. And so the IHT on the remainder of your estate would be 40% of £175,000, so the bit over the nil rate band, which would be £70,000 tax bill on that part. So in total, a tax bill of £150,000 if you thought the taper relief applied to the whole of the failed gift. So that is, about £80,000 difference in the kind of expected tax bill versus the tax bill you actually got, which is a huge difference.
Yeah. And look, I think that, the point of having this discussion and working through examples like that, obviously, whether they apply, whether that's at all applicable to you is up for discussion. But the point is, it's complicated.
Yeah.
And even though this is a personal tax and you would hope it's understandable by individuals, it probably isn't going to be understandable for a lot of people.
Yeah.
And it's a great advert for, if you need it, for getting professional advice around this stuff, right? Because as we can see, there's all sorts of potential ways to use the rules and use the system to reduce your liabilities, but it might not be obvious to ordinary people.
Absolutely. And I wrote an article just last week on the kind of most costly IHT mistakes that people make, of which this is one, but there are others. And so it definitely pays to get financial advice on an area as complex as this.
Yes. Now, we've got a budget coming up in a few weeks' time. And a lot of the personal taxes that affect our finances are going to be potentially on the table and subject to perhaps tax rises. We know that the government has been looking at ways to raise more tax. It sort of has to, given the fiscal position of the country. There's been a lot of talk about wealth taxes. IHT is a wealth tax, one of the few that we have. Could the 7-year rule be one area that the Treasury looks at as a target when the budget comes around?
It's definitely possible. There has been some speculation, and we should obviously say that, acting on pure speculation might not be a good idea and could be very costly in the long run. However, there are a few things that, the Treasury might look to do. So number one, they could potentially look to introduce a lifetime cap on gifts. So, it might be 100K, for example, that you can pass on. And then after that, there will be IHT on any gifts. Or, for example, the 7-year rule could be extended. So if you made the 7-year rule 8 years, 9 years longer, then there's likely to be more gifts that fall into failed gift territory. Or you could get rid of taper relief entirely because, clearly people don't really understand it.
Yeah, and we should say here that in a way, the government is taking more and more through IHT every single year because that 325 rate is frozen. It's been frozen. I looked at this and it was, and I'm not going to be able to remember the year. It's 2009, 2010,
I think
something like that, that the last time it was increased. That's a hell of a long time for it to be frozen and for estates to be growing in size, for house prices to be getting higher, for investment returns to be making estates bigger and bigger and bigger. More is being taken in inheritance tax, even if they do nothing at all.
Absolutely.
I will say, and this applies to any speculation that people read around the budget.
Yeah.
No one knows anything for sure.
Yeah.
Most of all us. But I would say it's highly unusual for the Treasury, for the government to make changes in a kind of retrospective way.
Yeah.
So normally, again, there's touch words, you never know, but it would be highly controversial for the government to make changes to IHT or to pensions is the other big one. In a way that means money already contributed or already planned would then be suddenly subjected to different rules.
Yeah.
I mean, there would be a real basic fairness issue, I think, actually, if the government did any of that. Doesn't mean they can't do it. And lots of people have a very sort of cynical view of what the government might do with taxes. But that's worth saying, isn't it? That, it isn't necessarily the case that even if tax rises come along, they're going to be applied retrospectively.
Absolutely. And on the idea of a lifetime cap, I think in practice this would be really hard to implement, because are you going to start monitoring how much pocket money parents give to their kids when they're 6 or 7 years old? It's almost impossible to police.
Yeah, it is indeed. Look, we've covered loads of ground there, Marianna, lots of technical stuff as well. So thank you for joining us. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel. It means that you'll get updated content as soon as it is released. Give us a like or share the episodes. It really does help people find what we're doing here. That said, Marianna, thanks for joining me.
Thanks, Ed.